It's the money that cycles, the cash that cycles in and out of your business on a daily basis, principally because of operations. So it's the money you receive from receivables and the money you pay out to buy inventory. It's all your expenses. I mean, strictly speaking, you don't include expenses in working capital, but it's money cycling in and out of your business. And it's hard for people to keep track of that. Although everybody's keenly aware of it. You're looking at your bank app right now while you're listening to this podcast. So that's what working capital is, the ebb and flow of money in and out of your business, principally through operations. I'll give you the official definition of working capital is the difference between current assets and current liabilities. And I think people, very few of the businesses I work with use their balance sheet very much. Had a lady the other day, she's all into an income statement. I asked her about her balance sheet. She said, I kind of really don't get that. Okay. So maybe we've done some talks on it before, but on your balance sheet, you have assets, liabilities, and equity. Assets are things that you own, right? Liabilities are things that you owe to others, and equity, which we won't talk about much, but is the difference between the two. That's what's left over for you as the owner. But assets are divided into two categories: current assets and long-term assets. Current assets are things that can be, they either are cash, so the money that you have in a bank is a current asset, or they're things that, at least theoretically, can be quickly converted into cash. That would be accounts receivable and inventory. Liabilities are also divided into current liabilities and long-term liabilities. Well, let me just say a long-term asset is your real estate, your trucks, your equipment, things that are going to be there for a while. Current liabilities are things that are soon going to require cash. So it's your credit cards, your accounts payable. If you get really into it, it's the current portion of your long-term debt, money that you're going to have to pay out this year on long-term debt. And then long-term liabilities are things like the mortgage that you have on your building, the loans you have on your truck. Maybe you have a line of credit that can be either place, but that's the distinction. So what working capital does is compares your current assets, things that are likely to bring in cash, either are cash or likely to bring in cash quickly, to your current liabilities, which are those things that are likely going to need cash real quickly. Like you got to pay your credit card, got to pay for the current portion of your debt. You're going to have, maybe you have a liability for accounts payable. Maybe you have a credit, or not a credit, a payroll that hasn't, or payroll taxes that haven't gone out yet. Right. They would all be up there. So the logic there is, hey, do I likely have enough cash coming in to pay the cash that I'm going to soon need to go out? So working capital, by definition, is the difference between those two. So you take current assets from your balance sheet. There's a line on your balance sheet. It says total current assets, and you subtract from that total current liabilities. And if that number is positive, meaning you have more current assets than current liabilities, it at least is an indication that you're okay.